Hello, and welcome to the Q4 2019 results presentation for BioSyent Inc. My name is Rene Gorham, and I'm the President and CEO of the company. I'll dispense with the reading of our disclaimer, but draw your attention to it. I'll start today's presentation with a look at our sales, EBITDA, and net income after tax for the quarter ended December 31st. So our sales for the period reached just under $5.6 million. That was a 6% decline from the year ago period. And we had some impacts on our EBITDA and net income after tax. And these resulted from some intangible asset write-downs for the quarter of $446,000. So that took us down to EBITDA of $1.7 million and net income after tax of $1.17 million. I'd like to point out that this represented our 38th consecutive profitable quarter, and that our ratio of EBITDA to sales still was above 30% at 31%, and our net income after tax ratio to sales was 21% for the quarter. Taking a look at the full year results, you can see our sales reached $21.42 million, essentially flat from the year ago period. We had some puts and takes in the business, and obviously the details are outlined in our MD&A and our financial statements, and I will walk through a couple of highlights on a by brand basis. So our Canadian pharmaceutical sales were up 2% versus year ago. Our international pharma sales were down 35%. I'll just draw your attention to previous reporting where we indicated that we had no sales to international customers for the first 6 months of the year. So in essence, all of the business that we did in 2019 was done in the second half of the year. So down 35% for that business segment, but a decent second half of the year. For the full year, we had non-recurring net intangible asset write-downs of $871,000. And we also had the impact of an increase in unrealized foreign exchange losses. So in combination, they impacted our full year results. Our EBITDA came in at $5.75 million, down 22% to the year ago. And our net income after tax was a little under $4.4 million. Once again, just to point out, our EBITDA ratio in this case for the full year ran at 27% to sales, and our net income after tax was 20% to sales. So looking at some of the individual products and segments, so our Q4 pharma sales of $5.47 million was down 7% versus Q4 of 2018. This was in essence driven by the shortfall in our international pharmaceutical business. Our Canadian pharma sales were flat to a year ago. Ferromax was flat, Repagyne up 11%, Cathogel down 8% in units to the quarter, Aguettant System down 6% to the quarter year ago, and Cysview up 17%. And as I pointed out before, we did have some softness in our international pharma sales. Sales of $430,000 was down 50% to the year ago, which was a very strong comparable quarter. Off a very modest base, our legacy business was up significantly, generated $100,000 in sales. We generally do not have much revenue for our legacy products in the fourth quarter of the year. So taken on a full year basis, our total pharma business was down 2%, once again impacted and driven by our international business. The Canadian pharma business was up 2% measured in dollars, so just under 19 million. On a brand basis, Ferromax units were up 1% on the year. Just a comment here, what we found during the course of the year was generally a contraction of the number of weeks supply that was held by our wholesale customers. So we measure our business, and I've commented on this in the past, we measure our business both in units and dollars, but we measure that in sales to our customers, which is obviously what we report, but we also measure secondary sales. So that would be sales by the wholesalers to individual pharmacies. And we found there that our business performed modestly better than you see here in the 1% unit volume gain for FeraMAX. Our Epigyne business was up 11% in units. Cathogel overall down 19% with a fairly robust back half of the year. I think we had some challenges in the earlier part of the year in the first half on that business. And we did suffer some account losses, but that seems to have stabilized at this point in time. And we have seen more of an upward trend of late in that business. The Agueton system sales up 18% in units and Cysview up 27%. So the international pharma business delivered 1.44 million, down 35% to the year ago. We did experience delays in shipping orders. We had orders in the first half of the year that we were not able to ship until the second half, and then that basically cascaded for the balance of the year. So we do have orders in hand for other export markets, and so we expect that business to continue to have some lumpiness. We've been reporting on this for some time, and we don't expect that to change anytime soon. Our legacy business had sales just over $1 million. That was up by 33% versus prior year. So a couple of highlights to report on. In May 2019, we received approval from Health Canada for Tibella, a women's health product. I have a slide in a moment to talk a little bit more about that product. In May 2019, FeraMAX was named the #1 recommended iron supplement brand in Canada for the 4th consecutive year. And I won't say too much about it, but we've got the early results back, and we expect that to be 5 consecutive years. In June of 2019, we announced the withdrawal of a submission for cardiovascular product approval with Health Canada, and we've also reported in the past of an asset impairment charge that we took at that time. That was done in the second quarter of last year. In August, we relocated our head office to Mississauga, Ontario. In September, BioSyent was named for the 7th consecutive year to the Growth 500 ranking of Canada's fastest growing companies. As the year progressed, in November, we signed an exclusive license and supply agreement for Combo Jisuk. I'm going to talk a little bit more about Combo Jisuk in a couple of moments. And in December, we announced that we had received TSX Venture approval for the subsequent 12 months, so to December of 2020, to repurchase up to 800,000 shares under a normal course issuer bid. So a couple of comments about Tibella. So it's a prescription medication, specifically a hormone replacement therapy. It is indicated for the short-term treatment of vasomotor symptoms resulting from estrogen deficiency in postmenopausal women. So per the Society of Obstetricians and Gynecologists in Canada, 60 to 80% of women will experience vasomotor symptoms. Primarily, these are hot flashes and night sweats. So this is essentially the problem that we will be addressing with Tibella, and it'll compete in a market, fairly well-populated market, competitive market for estrogen and progesterone products that range about $200 million in sales in Canada for hormone replacement therapy. So as we've previously announced, we plan to launch this product this year, and for competitive reasons, we're not going to give too much more information on that, but I think that the big question mark now is the impact of COVID-19 around our launch plan timing. So that would really be the only question at this stage. So I mentioned Combo Jisuk before. So Combo Jisuk is a double action product that combines acetaminophen and ibuprofen in a single pill. And it provides superior pain relief to either of those products on their own. So this is superior efficacy with clinical evidence. It certainly simplifies dosing. There are a number of healthcare professionals that recommend or prescribe those two compounds together after certain medical procedures. And what it does is it simplifies the dosing schedule and in fact improves safety of taking those two products with different dosing schedules. The safety of Jisuk on its own is similar to the safety of acetaminophen or ibuprofen on their own. So Jisuk is effective in pain relief caused by various ailments. It will compete in a market in Canada that's about $830 million. The product was approved by Health Canada, and we intend to make it available to Canadians and healthcare professionals later in the year this year. A couple comments on the NCIB. So as you know, we initiated an NCIB in December of 2018. I mentioned that we just in December of 2019 we got approval to continue with an NCIB to purchase, in this case, over 800,000 common shares in the 12 months ending 2020, December 2020. Under the previous NCIB, we essentially hit the maximum that we had approval for. And now if we add kind of since starting our purchases in December 18 to today's date, we've purchased over 1.1 million shares. And that represents a reduction in the outstanding shares on a fully diluted basis of 8%. And we have, as of the 16th of March, which is the date on which we're recording this presentation, 13,586,257 fully diluted shares outstanding. So I want to take a quick look at our balance sheet. With the black swan event of COVID-19, I think we're answering a little bit of the question of why we're conducting business with such a strong balance sheet. It's putting us in a position that we can manage our business with some confidence and make some decisions about how we move forward. A couple things to highlight. We had cash and equivalents of about $22 million on December 31st. That was after spending $6.4 million on share buybacks during the course of 2019. And if we take out our share buybacks, we generated cash of $3.9 million on the year. You're likely aware that there are some IFRS rules around leases and leasehold improvements and lease liabilities, and those are reflected both in assets and liabilities. So take note of that, and if you need more information, take a look at our financial statements on our MD&A. And then finally, we had a reduction of equity on the basis of the share buybacks. We repurchased during the course of the fiscal year, so 2019, 908,832 shares during the course of the year. So as I pointed out, our cash balance, this just gives you a little bit of a retrospective look at $22 million on December 31st. Versus 24 million in the 24.4 million a year ago. But keep in mind when you do the calculation that we generated 3.9 million and then spent $6.4 million in buying back shares. So that represented a 10% reduction in our cash position. If we look at our return on equity, this 5-year chart gives you kind of a look at our return on equity and our cash balance over time. So you can see back in 2015-16, where our equity base was fairly modest, our profitability showed a very strong ROE. In 2019, that ROE came down. So obviously our net income, as I've described at the start of this presentation, was down on a year-over-year basis, and we've done that on a pretty solid base, equity base as well. So the return on equity was down to 16%. I do have a couple things to point out here. One is that that the cash position that we have, $22 million, represents about $1.60 per fully diluted share as at December 31st. And that we clearly don't require all of the cash that we have on the balance sheet to operate our business. And if you took that out and recalculated our ROE, that would be 125%. And I've spoken about that in the past. The questions are a little bit around what are you doing with the capital? I think we've answered a little bit in terms of the share buybacks over the last 14 months or 15 months. We continue to look at assets that are in market and generating revenue. We've looked at a number of things over the last year. We continue to look at things, and I suspect with some of the madness in the market right now around COVID-19, there may be some opportunities come loose, but we'll see how that works out over the next period of time. So if we look at our fully diluted earnings per share, we came in at 31 cents for fiscal 19. That compares to 39 cents in the year ago period. Obviously, that's somewhat impacted by the reduction in shares, buying back shares. I'm just pointing out the obvious. We did have a 5 cent per share impact on non-recurring intangible asset write-downs. So these were write-downs against the cardiovascular assets that we talked about in our disclosure for Q2. We've also taken a write-down of asset value on Sysview and on international product dossier. So we term these as non-recurring. We don't expect that to have to be dealt with again. And so one could take a look at the EPS and compare it to a year ago on that basis. I'd like to make a couple of other remarks, not to go into any great length on restricted share units, but just to point out that earlier this month, we announced that the board had adopted a restricted share unit plan. There'll be more information on that at our annual general meeting and in all the materials that will be distributed in advance of that meeting. But in essence, we were looking for ways to provide some flexibility to the company to ideally in a non-dilutive way provide equity incentive compensation. So we look at it as it's intended as a functional replacement for options. We will continue to have an option plan. We do have some outstanding share options, but at this stage, we look at RSUs as a replacement for what we've been doing with options over the last number of years. So really focused on ways to provide that incentive and that link for our people, and to do that in a way that's non-dilutive. With respect to COVID-19, you'd have to be living under a rock not to know that this is going to have some impact on businesses in Canada and North America globally, and could have some impact on supply chains. As you know, we source our product primarily from partners or through partnerships with companies that are located outside of Canada. I say primarily. We do use some local contract manufacturing or contract packaging supply partners. So our products come from the US and Europe, and there obviously are big questions around what impact that could have on our business. What I could say about supply chain specifically is that we have inventory in stock and available that would see us out for quite a period of time. We have product that's on order, and we've checked in and have been now for the over a month. Have we been checking in with our partners around any potential interruptions to the supply chain, and so far we've got the green light on that. So we've got orders in place, and that we expect to be shipping over the next period of time that would see us out with our inventory that could run literally into the 6 to 9 months. So we're feeling comfortable with our current supply situation and our partnership arrangements and supply arrangements. The orders that we've received to date are pointing to a solid Q1. But of course, the full impact of COVID-19 on our business is yet to come. It is clearly having an impact on the healthcare system and the practices of both hospitals and healthcare providers in the community. And so we see that there will be interruption or hurdles in access to our customers while they take care of higher priorities. We are also exercising our responsibility for social distancing, both as it relates to business continuity internally inside of BioSyent, but also to do our part for the community, for our city, for our province, and for Canada. So it's difficult to know clearly the impacts that COVID-19 will have on our business, but it's something that we're actively managing, and we've got in place what we think will allow us to kind of continue operations and to manage our business in a way we're fairly well set up to manage through remote operations. We have asked our sales force. We've got 2 sales forces to manage their interactions with their customers. So we're not going into hospitals as of now, and we'll have to monitor that as the situation dictates. I want to finish today's presentation just with a quick snapshot at our share price or stock position, shares outstanding. So you can see here, as of March 16th closing, we were at $3.50. So just to remind you what I pointed out a little while ago, $1.60 of that is sitting on our balance sheet in the form of cash. And you can see that our common shares that are issued and outstanding are 13.4 million with 177,512 options issued as well. Thank you for your interest in BioSyent, and we look forward to perhaps a better business climate and hopefully soon. And we'll check in with you soon. Thanks.